Today, the markets are not looking very pretty. I have to acknowledge, though, that NVIDIA is holding up pretty well. My position in NVIDIA is holding steady and climbing a little bit. I'm excited about that, but not much else is going up. It's a red day. We had two trade setups this morning that printed hard in the Stocks with Josh Discord. Tesla puts to the downside, SPY puts to the downside. It was just too easy. I gave you guys the cross of price denoting the breakdown, and they printed and printed and printed. I hope you had an opportunity to jump on some of those, but I know that people are paralyzed and scared and their money's locked up in trades that are not working right now, and so it's hard to act and to take risk. I want to just encourage you that it's in times like this where there's a ton of money to be made, but right now it's only being made on the puts. I highlighted that for the last 2 weeks. Every profitable day has been made printing the puts to the downside, right? We had one day where calls worked and every other day it's been puts. So just keep that in mind. And some of you will say, I don't even know how. Well, come over to the Stocks with Josh Discord. There's education there. We've got people that can answer questions for you. You can find me over there. It's the name of the show, Stocks with Josh. www.stockswithjosh.com will take you to the website where you can sign up and join the pro trading community in my education platform. Okay, let's talk about these markets. What's going on? Well, we got the PPI and the markets were relatively flat from it. And so I think that even though the CPI came in soft and it gave us the idea that the Fed might loosen some of his restrictions on interest rates, the fact is we still have 3 Feds. And you say, why is that? Well, we've got Trump. He's absolutely able to crash this market simply by waging an intense tariff war. And so his role in the economy is absolutely as significant as Fed Jerome Powell. And I'm even elevating VP Elon to an elevated role of Fed Elon because the fact is the 2 biggest factors that the Fed looks at to determine whether he should loosen or tighten money control, one of them is unemployment, the other one is inflation. And right now, Fed Trump is impacting inflation and Fed Elon is impacting unemployment. Now, between the 2 of them, they can absolutely overwhelm Fed Jerome Powell and push us into a potential crash mode on Wall Street and put the Fed into a position where he's simply going to have to loosen the money. I identified before the reason why this would happen is not because of malice, but because they need to refinance their debt. They're $7 trillion in debt. And the minute they do that with lower interest rates, then they can begin to affordably print. They simply can't spend or print as much money as they would like at these elevated rates. So they've got to bring the rates down, a momentary crash, then the economy can continue to go forward. Now, if all of that plays out, it's a dangerous game, right? And it's going to be a rocky road for all of us. And it's going to be a trader's market, and a lot of money is going to be made writing puts and inverse ETFs to the downside. But if all of that works out, it really wouldn't have been necessarily a justified recession because we can put just as many people back to work through spending and building once the debt gets refinanced and we begin to spend more money, we can put a lot of people back to work and the economy can get back up on its feet. And we have a ton of innovation going on right now in the globalization of big tech that there's opportunity. And we will probably and likely finish the year higher, as a lot of big analyst firms have suggested that 2023, 2024 have printed huge profits, and 2025 will likely do as well. Now, let's go over some facts real quick. So Goldman Sachs came out with this report talking about how profitable corrections could be as long as they weren't right before a recession. And so that causes us to have to analyze this a little bit, but let's just outline what this report shows. Basically, it says that the annual return of the S&P 500, a lot of people have always known it to be 10%. Well, it's basically been on average 13%. We're doing a little bit better than normal. Now, the average decline from a correction is actually around 14%, which sets us up for a potential 27% move from the bottom of a correction to the top of the peak, the all-time high when the market recovers. And so that's a huge opportunity Goldman Sachs is trying to steer their clients to looking at. Now, they're looking at that because they're also not convinced that the economy is so weak that it's going to fall into a recession. It has a lot to do with our 3 Fed problem. If that balances out, then Goldman Sachs is telling everybody, guys, this could be wildly, wildly profitable. And I'm going to extend that same message to you. We pulled back into correction territory. Now we haven't found the buyers yet. The market isn't interested in buying Wall Street 10, 11% down, which is pretty concerning. It may need to go down an additional 4%. And so I wanted to bring that to your guys' attention. I'm going to remind you, control position size, put in your stop losses. There's nothing in the Stocks with Josh Discord that I've given you guys in the last week that didn't include a stop loss, because we have to be on high alert to protect our capital. Because if we can redeploy our capital when this market does turn around, we're going to have outstanding gains. Now, I want to talk a little bit about the AAII Bear Index I gave and showed you guys last week. I'm going to show it to you again because we hit a level of protection that is rarely seen, right? And what this is it measures the amount of puts and hedges that Wall Street is taking on their position. So they don't want to get stop lossed out of their NVIDIA. They're simply going to hedge their NVIDIA position. They're not going to sell it. They're going to buy a ton of puts to protect as insurance against NVIDIA going down. And they're probably sitting on some capital waiting for that perfect strategic price to load in. They'll cash out their puts, they'll load that into the shares, and the market will rip. But this indicator shows us that in past times when the put levels got this high, when the insurance levels of smart money got this high, it actually signaled a moment of market capitulation. We got this as a spike in 2022 on the October lows. Then we got it again on another spike equal to the one we just got in August of 2024. So this indicator and this chart tells us that this is almost to a place of sheer fear and panic, protection of capital, because they're aware of the fact that the market could get volatile and there could be an opportunity to cash in this insurance. But I really believe that they're going to take that and pile it into their positions, and it's going to cause that Goldman Sachs report about how profitable it can be, a 27% move in really just 2 to 3 months, to become extremely relevant to our conversation. So let's talk a little bit about corrections, how often the market gets them. The market gets a correction about every 1 year and 6 months, right? So basically 18 months. Now, we are actually ahead of schedule because we did have a 10% correction in 2022, greater than 10%, and we had one in 2024. And so right now we're on pace to have another one here in 2025. And so we are a little bit ahead of schedule, which means that the market is a little bit tense. It's a little bit more fearful. We need to see these indicators begin to calm down and slowly lose ground. And that will reveal to us that Wall Street is unwinding that hedge and that putting that money back to work in these positions. I believe that we may have seen a capitulation, or we are going to see a capitulation very, very soon. You want to be in a position where you can daily profit from this downturn, because what this report tells you is that Wall Street, it geared up to profit from this downturn with all of these puts. That's what that huge spike represents. Okay. I want to go over what are common causes for a correction in a bull market. For one, they're very common in bull markets. So you get that 10% correction quite often. But they're caused by 4 things. Disappointing data. Well, we've gotten some of that. Geopolitical tensions. Well, we have a ton of that with the tariffs. Central bank policy change, right? And as I said, we've got 3 Feds pushing the economy right now. And so Fed Jerome Powell had pivoted. And we know that between 6 to 12 months, when the Fed pivots, it leads to a recession. The question is, are we going to have a recession right now? Well, let's talk a little bit how long a bull market lasts. We've been in a bull market ever since 2020. So we're on our 5th year of a bull market, and bull markets typically last 5 to 7 years. Now, the fact that we're at the 5th year means that this could pivot into a recession, but we could just as equally squeeze out 2 more very strong years to this bull market if the fundamentals are remaining strong. And so that's the final part of this video that I want to go over with you guys. So recessions occur under 4 conditions after a yield curve inversion. Check. We got that. 6 to 18 months after a rate hike cycle. Check. The Fed pivoted back in September, and we're currently at 6 months. And so, again, it kind of highlights the possibility that the market should be getting cautious now because 4 of the recession indicators have already fired and triggered. And so a little volatility or a test of market strength is what we're going through because we're right at that point in time in which the market could begin to see some bad data and could begin to decline. No matter what, there's been profit taking and distribution in this environment. And when people go to put positions back on, they're going to reorganize their portfolios. I talked about this a ton in January and February that this was going to happen. And that's what we're seeing right now. The 2 other big indicators of what would signal a recession at hand is sudden stock market crashes. So check. We just got that. A very, very sharp decline from an all-time high. So 4 of those indicators we're checking off the list, unfortunately. Now, sudden market drawdowns like we saw here in March, extreme sell-offs mark or signal a level of instability that typically precedes a recession. Check, we've got that. As well as the final indicator, which is bad leading economic indicators called LEIs. Now, this one gets tricky, and this is where the story changes a little bit because this one is currently in the short term sending a very bearish message, but isn't 100% bearish. And it's probably one of the strongest indicators to determine whether or not we go from a 5-year bull run to a 7 or whether we jump into a recession early. Okay, it's one of the early indicators. And what are LEIs? Well, they're leading economic indicators, and I'm going to tell you the ones that matter. The first one is consumer confidence. Now, we all know that there has been a steady decline of consumer confidence over the last 3 months. I've talked a lot about it. 3 months ago, it dropped 3.3 points. Then the month after that, it dropped 5.4 points. And then this last month, it had a huge drop of 7 points. It meant that consumer confidence essentially fell off the cliff, okay? So that's one of the leading indicators, which is in the 4th category, which would determine how close a recession is, right? It's consumer confidence falling, and it did in the last 3 months. Now, another one is the Business Investments Index, and guess what? We've had the same thing there, 3 months of straight decline. This represents the small businesses and the confidence they have in hiring and putting money to work. When that begins to trail off, if they begin to lose confidence, then it means that the economy is likely to slow as people will not be getting hired. So we've seen a decline there. Now, the 2 other indicators which make up this 4th category as to whether or not we will get a recession right now is labor market conditions and monetary policy. Okay. So labor market conditions has actually been stable. All of the labor reports that we've gotten has been stable. However, we also take into consideration that they often get revised, and so there could be a pile of labor lies. And we have to take into consideration our trifecta Fed Elon, who could absolutely push us into a recession simply by cutting and cutting and cutting through the Department of Doge. So that's 3 of the 4. Now, the 4th one is monetary policy, and that's a stubborn Fed refusing to ease up on rates. If Jerome Powell, right, if he responds quickly to inflation before it begins to tick up because of the tariffs, he could tilt the economy back towards a Goldilocks environment where it remains strong and confidence returns, and we squeeze 2 more years out of this bull run, okay? And then from there, we have to assume that the economy remains in expansion because obviously economies expand and contract. So I've made a case for you today, and I know I've gone through it quickly and showed you some sheets, but the bottom line is more than 2/3 of everything is telling you to be cautious because a recession could be at hand. However, not everything is there. And the fact is that all 3 of our Feds, right, could shift this market right now, giving us another year or another 2 years of growth before the market would need to pull back some more. don't be so afraid of recessions. It typically just means that everything got too expensive and it gets repriced and brought down in value. Personally, if you ask me, Josh, what do you think will happen? Well, I'm not going to spend a ton of time on this. I'm going to have to save this for the next video because don't want this one to be too long. But let me just tell you that I don't believe that we have back-tested resistance enough times for the market to collapse and move into a recession right now. When you go back in time, and I showed you this, guys, about a week ago, the SPY tested resistance 3 times before it fell in 2022. Now, we've not tested the upper range of resistance at all right now, okay? And I think that even if we were to do it just once, it means that the market can climb back up between 580 and 590, which means that we have actually tons of room potentially to move higher before we actually go into that recession. And I will tell you that all of you need to assess the things I shared with you today, because we are definitely, if on the calculators, as far as I can determine it, we are between a 70 or greater % likelihood that we would go into a recession. However, the 3 Feds can push us back. Obviously, the number 1 Fed, Jerome Powell, is the strongest to ease, right, would immediately give life to the economy, pushing the market. All right, that's the storyline I'm going to drop for you guys today. Let me know in the comment section if you think we are going to have a recession in 2025 or if the market's going to successfully kick that R can down the road a little longer. Let me know in the comments. And don't sleep on the Stocks with Josh Discord. We make money every day. We live trade 5 days a week. I'm available on the top tier 2 days a week, Wednesday and Friday. But there's a lot of crown traders, and it's called the Chart Goat University. It's a place where you can get educated. We've got beautiful classes in there, and we have live sessions which we go over charts, and I'm constantly teaching. It's a great opportunity to grow and be surrounded by others who are encouraging you and sharing their own journey. Thank you guys for joining me today. Peace and blessings. We'll talk to you tomorrow. Bye-bye.